Infosys expected to report dollar revenue growth of about 1.5% in the third quarter while maintaining revenue guidance. HCL Tech's revenue growth is seen at 3.5% in what is a seasonally strong quarter for the company. Both trade higher ahead of numbers, though Infosys is off the highs. Kotak issues a bearish note on Nalco, downgrades the stock to a sell, citing limited upside in aluminum prices and a return dilutive capex program. Sources tell CNBC-TV18 that the government will invite expressions of interest for the Container Corp divestment this month itself. Stock trades mildly higher, off highs by worries of losing in market share. A big block trade in Nykaa, about $1.5 crore shares worth 217 crore rupees change hands. The deal took place at a price of 152 rupees a piece.
Hello and welcome to Chartbusters. I'm Nigel D'Souza. Joining me as always is Mangala Malu. And as we speak, well, it's a bit of a down day. The call earlier today was don't go ahead, don't chase that gap up opening, and that got sold into in a few minutes itself. The important point is now we are at that crucial support, the 17,800 odd mark. We have visited that numerous times in the last 7-8 trading sessions on, and we have bounced off that mark. So keep an eye out, 17,750, 17,800. You're going into a CPI print, which is expected to be a little bit softish coming out of the United States. So odds are that maybe, in fact, the market gets what it wants. But will we go into that event higher? Well, that's going to be quite crucial. For the time being, at a very, very important support zone. Sachidanand Utekar joins us to help us out with a trade on the index. Hi, Sachi. Good morning. At around 17,800, that's been a good entry point. Do you think this time around, we're going to break that and move lower? Would you look to buy the Nifty around this support zone?
Good morning, Nigel. Nigel, in fact, this is the third attempt wherein Nifty is making towards that 17,800, 840 mark, which is the 20-week exponential moving average zone. So I think the entire data set is still compelling us that this particular structure is still weak, and any particular pullback on the higher side should be utilized to create short positions. Even today, the way it respected the 5-day exponential moving average at around 17,930, and we have seen a decline from that. I think this particular decline may continue throughout the day. We're expecting the expiry to shape up somewhere close to 17,750, 17,700 kind of a zone. And that's why we have already initiated some short positions in the indices. So even right now, I think it is better to create fresh short positions in both the indices. When it comes to Nifty, the stop loss should be placed at around 17,910, and the pullbacks should be utilized to create fresh shorts for an intraday target of around 17,750. On the Bank Nifty, the resistance is very clear unless we don't see a close above 42,260 from here on. The pressure may still keep mounting. On the lower side, we are expecting a move towards 41,700, and the expiry should be somewhere close to that particular level itself, 41,700 to 41,600. So I think both the indices are in the bear grip, and we still expect the momentum to accelerate further.
All right, Sachi, thanks a lot for that. Meanwhile, a couple of stocks are actually doing well, not doing particularly bad this morning. We have L&T, which has moved to the high point of trade. It's recovered a bit from the lows, opened in the red. And the other one is Godrej Consumer from the broader market. That one, too, is negating the sort of moves that we're seeing in other FMCG stocks. Godrej Consumer has moved to the high point of trade as against something like an HCL, which is currently at the low point. Sachi, individual stock picks, what do you have on your list today for us?
Mangalam, we continue to be short on the private sector gains, especially from the banking side. We still continue with a short call in Axis Bank. Clearly, throughout this particular week, we have seen distribution signs. On the weekly scale, there's a clear-cut negative divergence. We have a shooting star formation on the weekly scale as well. We're expecting this particular move to extend towards 920. Fresh short positions are still recommended with a stop loss at around 948 from here on. On this, the other stock which is on our radar is Escorts. Again, here we have seen a fresh breakdown from a bearish pennant formation. There's a good negative crossover on its 5 and 20 exponential moving average, indicating fresh momentum. We're expecting this particular move to extend towards 2000, 2020 kind of a zone. Fresh shorts are advised here with a stop loss at around 2130.
All right. Thank you, Sachi, for joining in and giving us all those details. Meanwhile, let's just cut across to the Auto Expo in Delhi, where Maruti has unveiled two SUVs. Okay, we'll just watch those cars. It's called Fronx and Jimny. It is, of course, the SUV is coming in from the Maruti stable, which Maruti has been speaking about earlier as well. The color looks rather fancy, Nigel.
I think the Jimny is looking a little cool. You know, the one in the yellow out there that's up for you on the screen. I don't know whether it's going to be a bit of a competition to the Thar and the likes, because that's been selling like hotcakes.
It'll be interesting to see what they price it at, primarily because yesterday, you know, the one that Hyundai launched, the introductory offer was at a 45 lakh rupee price point, which I think would be a little too steep for me at least.
At least we're out of the market immediately.
We're off the market. But
when you price a car like that, we're out of the market.
We're immediately out of the market. And on top of that, it's an SUV. So we don't know the kind of gas guzzling that it does. But Maruti looks like should be a value product.
Yeah, it looks like. Let's see, the Fronx and the Jimny, both of them looking pretty okay. As we speak, the Jimny is the one that's catching my eye. Manglam, I don't know which one you're selecting among the two.
I like the cheaper one of the two.
Obviously, for the time being, it's just visually attractive to us. But we'll wait for the pricing and see how much of the market share they can garner. So let's move on for now.
Let's move on and let's get you some more ideas of profit that you can make, and then perhaps buy the Jimny and the Fronx that we just spoke about. This is a segment that comes in from our colleagues at Money Control Pro. Anubhav Sahu joins in.
Thanks. We are looking at investment thesis for the leading rubber chemical company, Nosil. Now, company's recent performance was sharply impacted by exports slowdown. Due to this, share of exports in sales has come below 30%. The domestic market didn't witness any degrowth, but given the drop in raw material prices, moderation in realization is also anticipated. Now, having said that, Nosil is looking through this soft phase and aiming to address the shortfall in capacities post-fiscal year 24. It has started debottlenecking capacities for certain grades, which will help it to meet the demand for another 1 to 2 years. Now, international clients, particularly those in US, want to contain the China supply chain risk. Crisis in Europe can further prompt US clients to diversify rubber chemical supply to vendors based out of India. Now, this trend should eventually help the company reach the goal of 40% sales from exports. Having said that, the translation of business inquiries into commercial opportunities would take time. In addition, domestic clients have tweaked the rubber chemical procurement strategy and are increasingly sourcing from Indian manufacturers. Coming to valuation, post-consolidation, stock is trading at 12 times EV by EBITDA for fiscal year 24. While a further compression in valuation multiple is possible, given the fragile global demand situation, investors should keep an eye on it to accumulate for medium to long term.
All right. Thanks a lot for that. With that, we'll step into a short break. On the other side, the management of IT Cementation waiting by to discuss outlook for the business going ahead. Welcome back. Let's get chatting to the corporate on our show. We have Mr. Prasad Patwardhan, who's the Chief Financial Officer at IT Cementation, joining in to discuss the business outlook for the company going ahead. And this, remember, is ahead of the results, so it will be an important one to watch out for in terms of how the performance was in the previous quarter, and more importantly, the qualitative commentary for the next couple of quarters as well. Thanks a lot, Mr. Patwardhan, for joining in. The last time you joined us, you said that you are eyeing orders of almost 10,000 crores this year. So far in the first 9 months, what's the order inflow been like? And do you hold on to that 10,000 crore plus inflow guidance for this year?
Good morning, and thank you for having me on your show. Yeah, I think we are good to go, good to reach the number of around 10,000 crores. We are already secured orders worth 8,000 plus crores in the 9-month period. And there's a healthy order pipeline and bids that have been submitted or will be submitted going forward. So I think 9 to 10,000 should definitely be on the cards for this financial year.
Hi, Mr. Patwardhan. Good morning. Nigel on this side. Good to speak to you after a while. So your total order book will be in that vicinity of around 23,000 crores?
That's correct. That's correct.
See, this is looking good, but the only thing the street is very cautious about is, what about your legacy orders? So I want to just take a few minutes to focus on that. As a percentage of this order book, how much is the legacy orders? Point number one. On those legacy orders, I understand that margins will be absolute zilch, or maybe you may not make any margins out there. And point number three is, by when will you get done with these legacy orders? Because the street wants to look ahead. The new projects will be far more lucrative. Go ahead, sir.
So there are 3 points that you picked up. The legacy orders would be in the range of 5 to 10% of our order book, not more than that. And most of those orders, it's not that those orders will not give us any margins, but the margins that we'll make on those orders would be significantly lower than what we make on the newer orders that we have secured in the last couple of years.
Okay.
And these orders, we expect them to really get out of our system in the next 2 quarters, I would say, 2 to 3 quarters max.
All right. And could you give us a sense of the margin differential between your new orders and the legacy orders? You said that, of course, the newer ones are more lucrative. If you could quantify that?
Well, difficult to quantify because these orders are in different stages of implementation and they are in different segments also. But some of the orders, where like Bangalore Metro, for example, where we have been losing money. And there are other orders where, the commodity prices, what they were when we bid for the projects, today the commodity prices are still higher than the bid prices. So we'll see, single digit or low single digit margins on some of those orders or nil margins on maybe 1 or 2 orders as well.
Okay.
But that should turn off in the next 2 or 3 quarters.
I think this clarification is important. The last time I chatted with you all as well, you all had briefly, mentioned about this, but the legacy orders getting out of the system by the middle of this fiscal is going to be extremely crucial because then the street focuses on new business. Let's focus on FY25. I don't ask you about FY23 because, you could be in a bit of a silent period. But for FY24, the earlier guidance was, you're going at around 1,500 crores per quarter. So in all probability for FY24, you hit around 6,000 crores of revenue with margins in that vicinity of around 10% odd. Is that gettable?
Well, we have been, our MD and I, both of us, we have been saying that we look for about a 25% growth in our top line for the next couple of years or 3 years.
Yeah.
And we'll go with that guidance right now. Margins, as we have stated, we'll see an improvement, a gradual improvement in our margins. And our endeavor is to reach, somewhere in the next year, 10% or cross that number in the next financial year. Whether we are able to do it for the whole year or not will depend on the legacy orders and how fast we are able to get out of them. But that is our aspiration and that is what we are working towards.
It's fair to assume that once the legacy orders are out of the system, by the virtue of your new orders, you will immediately hit 10% in terms of margins, right?
Well, that is the expectation. That's right.
All right. And, as far as your order book itself is concerned, of course, majority of it has been urban infra, highway, maritime, etc. Are there any other sectors which are more margin lucrative, which have a higher potential? I mean, are there any potential order wins coming in there in the near future?
Well, there are projects that we have bid for in these 2-3 segments as well. So if we were to get those orders, they would be margin accretive. But in our current order book, there are some tunneling orders or there's one irrigation order which is giving us, which will give us better margins going forward. So largely, we are in these 3 or 4 segments which tend to give us better margins. It's only the legacy orders and, the buildings or elevated metros where the margins have been muted or, we have lost money in the past. Okay,
all right, Mr. Patwardhan, what about the debt number? Given that you want to grow at 25-30% for the next few years, just a rough calculation, you do 6,000 crores, you move to around 7,500, then 9,000 crores. That's by 2025. You'll require money, right, to execute some of these orders. Peak debt levels? What, around 800-900 crores? That's the peak debt level?
Yeah, I think we should look at that number. And this year itself, we'll see some increase in debt. Largely, we'll see an increase in the term debt number because there will be a lot of capex that we are incurring mostly in this year, and maybe some of it may spill off into the next year as well. And all that capex is going to be funded largely through debt and through internal accruals. So we'll see an increase in debt this year in FY23. And to a lesser extent in FY24, but I guess that number of 800-900 crores would be reasonable, going forward for the next couple of years or so.
Mr. Patwardhan, usually, when there are a lot of elections, etc., and the next year has a lot of state elections, major state elections too. How do ordering, trends pan out in election years? Do we see muted activity ahead of elections and then perhaps post-elections an increase in orders? Just wanted to understand, because this year you will get 8,000-9,000 crores worth order inflows. Next year, what is the plan because of so many elections, etc.?
Well, state elections don't really impact us because we don't have too many state orders in our kitty, or we are not really focusing on state projects as such. The larger projects that we are looking at are funded by central government or PSUs. So that the state government elections won't really impact us to that extent. Yes, the Lok Sabha elections in FY24 and the code of conduct whenever it kicks in before that. So we'll see lesser ordering probably in the run up to the Lok Sabha elections. But we are sitting on a healthy order book today, so that won't really impact our operating performance in any significant.
So you won't hazard a guess on next year's order inflow, will you? Or is it too early?
We should look at some orders probably in the first 6 months of the next financial year, but then it will depend on the elections and how things pan out, keeping that in mind.
Okay, all right, Mr. Parkwadan, it's been good chatting with you. Well, the street likes what you have said. You have reiterated your guidance and the vision as well going ahead. We look forward to having a chat with you post your earnings numbers. For the time being, the stock has moved to the high point of the day. Let's pull up the intraday chart. Stock has spiked up a little bit. Time for a short break, but as we do that, here's some important information for our viewers. Don't miss out on the 19 must-have stocks for 2023. Subscribe to Money Control.
Welcome back. Let's talk about some important updates coming in from the Reliance Capital insolvency case. The Torrent Group has written to the Committee of Creditors asking them to immediately withdraw the second round of auction under the extended mechanism, failing which they will be compelled to take legal action. Ritu Singh joins in with more on this. Ritu.
That's right. Torrent has now written a letter to the Committee of Creditors and the Administrator of Reliance Capital terming the second round of auction illegal. It is said that the COC and the Administrator must immediately recall and annul this extended challenger mechanism. Otherwise, it will be forced to take legal action. It said that inviting a second round of auction would be in breach of the NCLT's interim orders, which prevented the COC from accepting any revisions in bids until its final order was given out, which is still awaited. The COC's letter to Torrent, which termed its highest NPV offer as of the first round suboptimal and therefore proposing a second round of auction, it believes is also in breach of the NCLT's orders. It further says that there is no provision in the IBC which permits a second round of the challenger mechanism, and therefore the COC was illegally trying to term this as extended mechanism, and which is why it has asked them to stop the process or it would be forced to take legal action. It further went on to allege that the COC and administrators' action to conduct this second round of bidding reeks of collusion, and that the process of commercial wisdom and the process of value maximization has already been concluded. Now, while Torrent has objected to the second round, the NCLT is expected to take up the Reliance Capital case today, and their verdict or final say in the matter is what is going to decide the future course of action.
Well, we'll keep an eye out on that interesting story, Ritu. Thanks so much for that. Well, moving on then, sources are telling us that the government will invite EOIs for the Concord divestment later this month. Mangalam, tell us what brokerage house Macquarie is making of the stock.
Well, it's a bit of a tug-of-war between two news pieces on Container Corp, which is why when the stock goes up, there is a lid on the gains that it gets. And every time it falls, there is some sort of support at the lower levels as well. What is exactly happening? One, the big trigger for Container Corp is that the government's privatization drive, and that's what Macquarie bets on as well. On to that, we have news reports that the government will likely invite expressions of interest later this month. Were that to happen, that would be a big positive. However, what's pulling down the stock is the fact that volumes aren't growing for them. The third quarter volume growth, the reported volume growth is just 5.2% year-on-year. Quarter-on-quarter, it's a decline. Domestic volume growth is up 24%, but Exim, which is the mainstay of the company, has grown just about 0.5% higher, and which is why Macquarie is, a little cautious on the stock. They have an underperform rating with a target of 622 rupees. They believe that the third quarter Exim handling volume actually indicates that the company is losing market share. And importantly, we are 6 months into the dedicated freight corridor operations which are on, and it's shown no real model shift to, rail as against roadways right now. So that may be a bit of a problem for the business going forward. But again, divestment of the government stake will be a key catalyst. That's about the tug of war. Okay, all right. Well, on that note, though, we'll have to wrap up on this edition of Chartbusters. You stay with us. Trading Hour comes up next.